What a day these markets have given us. This is Macro Money. I'm Ilya Spivak, head of global macro here at tastylive. And what a day to be talking about macro. The world is seemingly roiling with just that kind of risk. And we're going to try to pick it all apart here and see what is happening in these markets. And most importantly, what is likely to be in front of us next as all of this plays out. We'll begin, of course, with a look at how these markets performed today and what that price action seems to suggest. And then we'll see what this all might look like going forward. It's certainly not the kind of week that one might have thought about looking at the economic calendar, which is relatively bare bones, but nevertheless, an explosive start here coming back from the Martin Luther King Jr. Day holiday in the U.S., S&P down 2%, NASDAQ down a little bit over 2%, yields up, in particular at the long end, 10-year up 1.6%, relatively flat at the front end, and that's understandable in context. We'll take a look at that momentarily. Crude oil up a bit, almost 0.6%. Gold, the standout, up 3.57%. Euro showing us some gains and telling us that the U.S. dollar is significantly diminished here. So perhaps the most important thing here is to take a look at just where we are on stock markets and see if we can't make sense of, first and foremost, just the positioning and the narrative. Now, of course, we came into this reopening, this post-holiday reopening, with the markets already in a mood. And that's, of course, because over the weekend, the tiff between U.S. President Donald Trump, Denmark, and the broader European Union seemed to get meaningfully worse. The president issued the threat that if we don't get to figuring out how the U.S. is going to purchase Greenland, a semi-autonomous region that Denmark owns, from Denmark, then there's going to be tariffs that start on February the 1st, an extra tariff of 10%. And then if there's not progress from there, then in June, that extra hit will amount to 25%. Now, on one hand, this is not the world's biggest deal from a strict tariff as impacting growth perspective. And that's from an analysis from a number of sources that were synthesized by The Economist magazine over the weekend here. And the sort of median guesstimate comes down to show that were this worst case scenario to occur, you would have a situation where you're shaving off about 0.06% from U.S. GDP this year as a consequence of the trade being disrupted by these extra tariffs, and 0.08% from European Union GDP. So it's not exactly the world's craziest hit. This then is something else. It's not about the economic implications of these extra tariffs. It seems more about the breaking of international norms, in particular, the threat to NATO. Of course, both the U.S. and Denmark are NATO members, and the commitment under Article 5 of NATO, whereby an attack on one member is considered an attack on all, wouldn't really make a whole lot of sense if one NATO member is attacking another. Now, that's not unprecedented. It's happened before. The U.S. and Europe have found themselves on opposite sides of crises, even shortly after NATO was created around the Suez Crisis in the 1950s. So it's not like this hasn't happened. Turkey and Greece have gotten into it on multiple occasions. So this is not the only time that we've seen the alliance threatened, but it is certainly the most serious in recent memory, and in that it involves the U.S., which is basically the muscle behind NATO, the more sort of serious it becomes. And the markets, of course, clearly are taking a similar page here as they pulled from the playbook when Liberation Day occurred last year, right around the panic lows in late March, early April, because, of course, that was seen as an inexplicably damning policy for the United States, where were that to have been something that the U.S. would have followed through on, as it was stated, it looked as though the U.S. was absolutely determined to keep living in a house after kicking out the house's foundation. Because, of course, to have disrupted commerce in the way that bilateral reciprocal tariffs looked like they could have at the time would have basically meant the destruction of the dollar recycling system that keeps interest rates relatively anchored in the United States, keeps our borrowing costs manageable, and keeps the government and the broader economy working, without which none of those things could happen. And then who knows what might occur. The US dollar and the US Treasury bond are bedrock pillars upon which the whole of global commerce stands. And what a trade policy like that would have meant was those things unraveling. And obviously, there is no playbook for that level of financial Armageddon. So, not surprisingly, once that very powerful signal came from the markets that, look, we've gone into sell America mode, you need to rethink this, not unnoticed by the markets, the administration went backwards, and there was a quickly 90-day pause on the tariffs, and then another, and then things were wound down to something different ultimately. Now, if you look at the price action today, you see something very similar. And this is where that decline in bonds makes a lot of sense. Now, going back here, we can see there's seemingly a risk premium that's entering the long end here. And so there's less so a conversation about interest rates here, interest rates there. That maybe is why we have such a modest move at the short end, because there's still rate cuts there. And of course, this kind of commotion only engenders more in that direction, maybe. But at the long end, where there is lots of uncertainty, lots of term premium to price in around situations like this, yields actually go higher, because this kind of commotion demands that markets be paid for additional time risk. And that, of course, among other things, does the opposite of what the president wants on interest rates. It actually sends them higher, whereas, of course, the president is a big fan and a loud one of sending them lower. And if we look at the capacity for this to continue, we can see it here. We have a meaningful breakdown in the S&P. Tellingly, of course, it still had not made a higher high since late October, when the Fed told markets they were over-extrapolating rate cut expectations, and Fed Chair Powell basically chastised investors at the press conference following that FOMC meeting. We couldn't make a new high for that entire time. So all of November, all of December. Now, of course, we've been rejected from an attempt to do that. That was perhaps the most spirited in January. Not only that, but we've taken out the prior low. So it would appear as though the markets are trying to find their way to deeper losses where this then becomes the next bogey. And after that, perhaps all the way back down here. The story in bonds, this is what sort of makes this a kind of sell America situation, is not much better. There was an attempt to break out last week on the top side, and clearly that's been overturned. And now it's looking like we're breaking down, not up. Again, we've taken out a major swing level here and established a lower low. So it's not unreasonable now to think about the September bottom as where this might be headed. And of course, to complete the sell America trifecta, here's the US dollar. Massive euro rally today. In fact, the euro does better than all the other currencies for the most part, all the other major currencies, certainly. And that just seems to speak volumes about what the market's verdict on this is and who this is bad for. So when we look at this, we don't quite have the same convincing breakout as we do elsewhere. Again, with the bonds, there's a clean range break. With stocks, there's a clean break of a former low, and of course of the rising series of highs and lows starting back here from these lows in December, November or so. But for the dollar, it's a bit of a different story. We're still sort of clawing within a range in place basically since July, where the dollar has been, after an awful first 6 months of last year, basically stuck in consolidation mode. And the highs within this thing have been getting lower. So perhaps the dollar isn't quite ready to make a lasting run. I suppose we'll see what the president and his European counterparts come to in conversation at the World Economic Forum in Davos, where all of them now are. Maybe this is the place where everybody grabs them a scotch and figures this thing out. Gold, for its part, continues to surge. We have a new record high here. And because we're in uncharted territory, there's not really reference levels up here, but the natural sort of gravitational point psychologically might well be the 5,000 mark, just because it's a big round number with lots of zeros. But otherwise, the story in gold has been consistent. It's been about markets wanting a non-sovereign way to transfer value, in particular because the US and China are at odds, and the spheres of influence might become unstuck from each other and become increasingly siloed. Needless to say, what we're seeing here today just encourages that kind of thinking. And so, not surprisingly, a massive rally for gold. To sort of put the finishing touches on our analysis of the price action here, a look at Bitcoin. It is down 6.25%, which of course tells us that if this was going to be some sort of anti-dollar, anti-fiat conversation and Bitcoin were thought to be a viable alternative, things would look different. Gold clearly is seen that way and does look different. Bitcoin, of course, is instead doing its amplified risk sentiment thing, where it's got about a 3 times move of what the S&P has done, a little bit more. And that just looks like a risk on, risk off sort of a thing, where stocks are down, so Bitcoin is down more as a more speculative, more volatile type of instrument, pulling in the same direction. Now, where this goes from here is, of course, the most fascinating part of the story. And it really seems to go back to the disparity that the markets have been outlining and have been agonizing about for some time on monetary policy expectations. Less so because those policy expectations reflect this or that thing economically. More so because they reflect the market's abiding desire for a safety blanket to wrap themselves in the event of precisely this kind of left field volatility that we are seeing here today, and that may well be in the cards here for some time yet. We can certainly walk this one back. We've walked others back before. The tariffs are just one example. But we certainly have shown here a capacity for pulling volatility out of a hat where it wasn't necessarily there. This is not an economic release that went awry. The U.S. economy, by all accounts, seems to be doing quite well. Inflation seems to be going in the direction that the Fed wants it. That is to say, it is cooling. And the service sector side is where the cooling seems to be most acute. The tariffs from inflation on the goods side, at least as far as consumers are concerned, seem to be starting to plateau, as the Fed foretold. Although we do have some PPI data warning of issues maybe starting to creep up in the pipeline, but they haven't made it up to consumers yet. So far, so good, at least. And for the most part, things seem to be on relatively strong footing. And so what's most interesting, of course, in that context is that the markets have been rapidly demanding rate cuts. They've walked them back a little bit, but still the consensus forecast is for 2 cuts as overwhelmingly likely this year. This is what we've got baked in here into Fed funds futures, 45 basis points for this year. That's very strong odds of 2 cuts at 25 basis points apiece. So for a total of 50, we're under priced for it just a little, but only a little, only 5 basis points off. And of course, that is in contrast to what the Fed has told us, which is only 1 cut this year and another next year. So while both the markets and the Fed have 50 basis points through end 2027, give or take, the Fed is thinking in more spaced out terms, and the markets are thinking much more immediately. And that's ostensibly because of exactly what we're seeing here today. This is the Economic Policy Uncertainty Index. It tracks levels of policy uncertainty by analyzing news articles for the most part. And you can see this data is very old and very well worn. This is a historical series here going back to 1985. So clearly, there's a whole lot of examples here of this data and how it sort of paints the narrative. We can see here is the dot-com crisis. Here is the global financial crisis and the Eurozone debt crisis. Here is COVID. Here is now. And we can see that while certainly during the dot-com crisis, there was a meaningful concern about economic policy uncertainty and what was going to get done. Around the 08-09 mortgage crisis, the Great Recession, the financial crisis, the Eurozone debt crisis, all of which are kind of back-to-back here, not quite as bad as the dot-com crisis. Central banks have a little bit more credibility here, but obviously concern about what might be done. And COVID takes us to a whole new high here, of course, because we start using non-conventional policy measures at a clip that we hadn't seen in sort of the modern post 1970s fiat dollar era, like shutting down most of the global economy, say. But the situation now is essentially adjacent to COVID level uncertainty. And we can see the fuzz around the 30-day average here is very dramatic. That is to say, there's tons and tons of volatility here. And so it isn't so much that the markets are afraid of this or that thing, or the economy is doing this or that untoward turn economically. It's that there is a desire from the markets to have cheap money as a hedge in the event that one of these types of things, like we're witnessing right here, comes out of nowhere. People wipe out because their bets go wrong for no reason other than a strange U-turn in U.S. policy, and people end up losing money. They would much rather have lower interest rates to be able to borrow back and go again in that environment. And here's a specific trade policy uncertainty index. We can see here last year that there was this ugly spike. This was the last time we were in Sell America mode in April, so early into the second quarter. It has, of course, since come down because the tariff conversation has cooled, but the amount of volatility around these averages, it's a 7-day moving average and a 30-day moving average, or the amount of volatility around this still is very, very significant. Compare that to even the COVID year, where policy volatility is tightly wound around the trend averages. And so as we look at all of this, then we see that the volatility, even as a perception, is already having a negative impact. We see global trade volumes actually fell last year. Not only that, but in year-on-year terms, they fell by the most significant clip since the 08-09 crisis. This is worse for global trade volumes than COVID, in other words, with the global shutdowns. And of course, if we start to peel apart NATO, and the roadblocks to global commerce aren't just mainly along the US-China artery, which is of course critical, but it is also along the US-Europe artery, well, then we've severed the connective tissue between the US and both of the other two major nodes of the global economy and of global GDP. More than half of global GDP is just the Eurozone, China, and the US. With the US roughly around a quarter, and China and Europe just under a fifth apiece of global GDP. And so we're looking at already this uncertainty driving down commerce and creating roadblocks in key supply chains. If there were a geopolitically motivated rupture in relations with Europe, that situation would only get worse. And of course, that is a tremendous risk to something like the AI sector, which has been almost singularly the engine for equity market outperformance, because as we can see, this supply chain is tremendously integrated across borders. While 38% of it is in the US, understandably, because most of the leading models are here, the supply chain is deep. The chip lithography, for example, that's necessary, that's in Europe. That's in the Netherlands. And of course, that relationship would suffer, though that access would suffer were NATO to be stressed like this. Needless to say, a huge chunk is in Asia as well, of which China, of course, is a major component, but so are Taiwan, Japan, Korea. And so this sort of thing is a direct risk to the very things that have kept this market relatively aloft this whole time. So the question now, of course, is perhaps less about this or that economic development and more about what this will mean for the conversation at Davos, because it seems like that is the forum where something like the current situation might actually see some kind of movement in a direction. But nevertheless, we do have a bit of economic news on this calendar for the week. It isn't much. We've got the backfill of U.S. PCE data. That's the Fed's favored inflation gauge, but that's not going to be the recent numbers. We, of course, have CPI up to December now. This will be the PCE report up through November. We can see the expectations here are for a little bit of a downtick on inflation, but it's really an open question as to whether that matters to anyone, because, of course, the data is already stale. Moreover, there are bigger fish to fry here with everything else that is going on. And then from a positioning perspective, there's not too much to change. We have this gold exposure that's going to come up on contract rollover next week. So that's something to think about. But for now, I'm still sitting in the February contract, and that seems to be working. I haven't jettisoned my US dollar longs because, as we mentioned, it seems to be less inclined to go down than our stocks and bonds. I've flipped over my long end of the curve position. And of course, last week, as we talked about, I took this hedge in the belly of the curve. This is IEF that is a tracker of 7 to 10 year U.S. Treasuries. And I got a put vertical on here last week, looking for maybe fewer rate cuts sooner, more rate cuts later kind of an idea. Now, of course, I've flipped over TLT into a put vertical as well after this breakdown. I'm still long oil. I'm still short risk via the Qs and SPY, so both NASDAQ and the S&P 500. Those put verticals remain. And I'm still on the call vertical side of Bitcoin in IBIT, but if it breaks much lower from here, that might have to get overturned in the opposite direction. See how that goes here in the coming days. This is Macro Money for today. As ever, we are here after overtime. That's a show that I co-host with Chris Vecchio, looking at the Wall Street close and where things might go there from. I'm writing for the news and insights portion of tastylive.com and commenting at Ilya Spivak on former Twitter and on Blue Sky. If you're watching this on YouTube, like and subscribe. Macro Money is back tomorrow. In the meantime, happy trading.